Information about an NPO's expenses in general, and fundraising costs in particular, are important to users of general-purpose financial statements. This video explains the proposals in INPAG Exposure Draft 3 for the classification and reporting of expenses. It will cover the analysis of expenses by nature, function, or a mixture, and outline the cost allocation principles to calculate direct, shared, and support costs. We will explain the presentation and disclosure requirements for expenses, and touch on the treatment of capital expenditure. We'll also describe the proposals in relation to personnel costs and fundraising costs. Guidance for the classification of NPO expenses is found in INPAG Section 24, Part 2. In recognition of the diversity in the sector, there is flexibility in the options for presenting expenses. NPOs may provide an analysis of expenses using one of three classification approaches. It can be based on the nature of expenses, the function of expenses within the NPO, or a mixed presentation that combines parts of the nature and function of expenses approaches. Where expenses are classified based on their nature, the analysis shows the inputs that an NPO uses for the activities it carries out to meet its mission, such as paying for staff, premises, or travel. An NPO must show the categories of spend that provide the most relevant and reliable information to the users of the NPO's financial statements. The example shows what an analysis of expenses by nature may look like and includes typical expense items, such as staff costs, rent rates and utilities, medical supplies, and grants made. Where expenses are classified by function, the expense analysis shows the cost of the activities that the NPO has carried out. A function of expense analysis might show major programs such as education and counseling services or research and development or administration activities. To produce an expense analysis based on function, an NPO must allocate and combine expenses according to the activity to which each function relates. Where an NPO chooses to present an analysis by function, it is necessary to provide a narrative description of the material types of expenses which comprise each activity. NPOs don't need to disclose the amount spent on each type of expense with this description, just the nature. In this example, the analysis shows the cost of its activities on education and counseling services, research and development programs, fundraising activities, and support activities. The analysis of activities and programs should provide information that is the most relevant and reliable to the users of the NPO's financial statements. For this example, the types of costs included within educational activities is provided in a narrative description as shown. This would also need to be provided for the other functions presented. A mixed presentation basis is where expenses are classified in part by nature and in part by function. This will see some expenses presented by type, but other transactions allocated and aggregated according to the activity they relate to. Where an NPO chooses to present expense items using a mixed presentation, a narrative description of the material expense types within each functional activity must also be provided. Here is an example of an analysis of expenses using a mixed presentation. It includes an NPO's costs of providing test kits, which is relevant in this case because they expect to recover the cost from service users. In this example, the NPO also carries out other activities which are better understood by the inputs, and therefore staff costs, premises costs, and depreciation are shown separately for these. The use of classification according to the functions or nature of expenses should provide the information that is most relevant and reliable to the users of the NPO's financial statements. A narrative explanation is provided to describe the material expense types of each of the activities in the functional element of the presentation. Although NPOs are permitted to choose the classification method, the proposals also include a rebuttable presumption. The presumption is that the most relevant and reliable information for users of the financial statements will be provided by a nature of expenses analysis, so this is the default. However, an NPO can form a judgment that the default analysis by nature of expenses will not provide information that is more relevant and reliable to the users of its financial statements, and instead choose a presentation based on functional or mixed classification. In this case, a note must be provided to explain why the alternative analysis provides information that is more relevant and reliable to the users of the financial statements. In making the judgment about which classification to use, an NPO must consider a number of factors including which method is more relevant and reliable, For example, where an NPO generates surpluses from retail activities, which it uses to fund its missional activities, reporting a cost of sales line item might be more relevant and reliable. In this case, a functional analysis might be most appropriate. Which method represents the way in which the NPO is managed? Where an NPO is managed according to its programs of activity, such as emergency response and educational programs, a more relevant and reliable way of presenting these costs might be a functional analysis. Sector practice. Where a sector or a particular type of NPO normally uses one form of classification, consistency may enable comparison of expenses of different NPOs within that sector, as well as providing the most relevant information. If allocation of expenses to functions would be essentially arbitrary, then it would not provide reliable or relevant information. Whichever classification method is used, NPOs can choose to present the information either on the face of the statement of income and expenses or in the notes to the financial statements. INPAG provides guidance on the allocation and aggregation of expenses. This will be needed where a functional or mixed classification of expenses is used. It may also be needed to calculate fundraising costs, or to calculate support costs where supplementary statements are prepared in accordance with INPAG Practice Guide 1. Methods need to be reasonable and consistently applied to all activities, and also be consistent between reporting periods unless circumstances change. Methods selected must also ensure that the accounts faithfully represent the costs of activities. Section 24, Part 2, provides general principles that need to be followed by an NPO when allocating expenses. It identifies costs as being either direct costs, shared costs, or support costs. A direct cost is a cost that is only for the purpose of a single activity. It can therefore be directly attributed to that activity. For example, the staff costs of an individual employee who works only on one project are directly attributable to that project. All of the staff costs of that employee must therefore be allocated to that activity. If that individual employee spent half of their time working on one project and half on another, their staff costs are still directly attributable, but they need to be allocated between the two projects. In INPAG, these are referred to as shared costs. Where there are shared costs, a suitable basis must be applied to allocate the costs to the relevant activities. In this example, time spent by the employee on each project would be a suitable basis. For running costs of a vehicle used by more than one project, the distance driven for the purposes of each project might be a more suitable base. Support costs are those costs incurred on the activities which are necessary to administer and manage the NPO as a whole. For example, the staff costs of an individual that works on governance issues that are necessary for the overall functioning of the NPO. Support costs relate to all the activities of the NPO, so they cannot be directly attributable to an individual activity. For example, an NPO may decide that costs related to governance should be apportioned to activities, based on the percentage of the NPO's operational budget those activities comprise. This example demonstrates these general principles. An NPO rents an office building for $1,000 per month. Monthly rent is allocated to the NPO's activities, based on floor space occupied as follows. Rent is allocated to an activity for the space occupied where staff are working directly on an activity. These are shared costs that are allocated based on the area of space occupied by each staff member or team. In this example, 25% of the floor space is occupied by staff working on activity A, and 25% is occupied by staff who work on activity B. As a consequence of charging the rent costs to direct activities, $250 is charged to activity A, and $250 is charged to activity B. The remaining 50% of the floor space is used by staff carrying out support activities, so $500 is charged to support costs. This cost is then apportioned to the direct activities, based on the respective operational budgets. Activity A is 20% and activity B is 80%. Therefore, 20% of $500, that is $100, is charged to activity A, and 80%, which is $400, is charged to activity B. Other sections of INPAG require the disclosure of expense information. For example, Section 17 on property, plant, and equipment requires the disclosure of the annual depreciation charged. In developing INPAG, it was decided that if expenses information is required to be disclosed by another section of INPAG, it should form part of the disclosures related to that section, and it does not have to appear in a separate disclosure note about expenses. However, there are two specific disclosures included in Section 24, Part 2. Firstly, benefits to volunteers, such as free or subsidized services or goods. These must be disclosed separately. This applies to all volunteers, except where a volunteer is a related party. Where this is the case, any benefits must be reported under the related party disclosure requirements. Secondly, losses, write-offs, and special payments. These must also be reported separately. These might be cash losses through fraud or theft, or where there have been unrecoverable overpayments, which have to be written off. Special payments might also include payments to contractors outside of a binding contract, compensation payments, and severance payments. In some jurisdictions, it is common practice for NPOs to expense grant-funded assets. It is worth noting that in INPAG, all material additions of property, plant, and equipment that meet the definition of an asset in Section 17 are capitalized, irrespective of the source of funding. Section 17 of INPAG also requires depreciation to be charged to the statement of income and expenses. Depreciation is charged to the same fund as the asset. For example, if there are restrictions on the way the asset may be used, the asset would be part of fund with restrictions. For purposes of reporting to donors, the standard format in INPAG Practice Guide 1, Supplementary Statements, includes the option to remove depreciation and show capital expenditure, which is a preference for many donors. Further information can be found in the videos shown, the links are in the description below. The cost of employees is often significant for NPOs. It is a cost that attracts interest from users of the financial statements. The inclusion of employee costs was discussed with advisory groups, and there was consensus that these should be disclosed. Following the principle to disclose expense information alongside other relevant information, Exposure Draft 3 includes an amendment to the disclosures of short-term employee benefits, which was included in Exposure Draft 2. There are also some amendments to the disclosure requirements for related parties. For short-term employee expenses, INPAG now requires the separate disclosure of the following costs: wages, salaries, and Social Security contributions, non-monetary benefits for current employees, such as medical care, housing, cars, and free or subsidized goods or services, other than those provided on the same terms as other eligible service recipients. Bonuses paid within 12 months after the end of the reporting period in which the employees render the related service, and other staff-related statutory or contractual costs. When considering related party transactions, a small number of changes are proposed to the disclosure requirements, and the types of transactions have been broadened to include grants and donations. A new requirement is proposed to disclose compensation to governing body members. Governing body members are individuals that have responsibility for oversight of the NPO's activities, whether or not they are paid. These persons might also be described as trustees or board members. The disclosure includes all forms of personnel compensation benefits, with the same scope as Section 28 for employee benefits. This includes whether the payments have been made by the NPO or on its behalf. The legal basis of the personnel compensation paid must also be disclosed. The following disclosures are required in the notes to the financial statements. Either none of the members of the governing body have been paid any compensation or benefits from their work with the NPO, or one or more of the members of the governing body has been paid compensation or other benefits from employment with the NPO. If compensation has been paid, the following disclosures are required: who was paid and the nature of the work they were paid for, the legal arrangement for payment, and confirmation that the NPO is allowed to make such payments under the law or in accordance with the NPO's constitution. The amount paid must be broken down between salary, pension, and other benefits. In addition, where governing body members have claimed expenses, the NPO will need to disclose how many members have been paid, and the value of any material expenses paid, disclosing their type or nature. There are two exemptions for the disclosure of related party transactions for governing body members. A grant or donation made by a member does not need to be disclosed, provided there are no special obligations to amend an NPO's normal activities, such as the use of certain suppliers or sources of inputs. All enforceable grant arrangements will need to be disclosed, because they impose specific performance requirements on the NPO. Also, services received by a governing body member do not need to be disclosed, where they are received on the same terms as any other eligible recipient. INPAG includes separate guidance on reporting the cost of fundraising. These proposals are included in Section 24, Part 3. The proposals have been developed to provide a more transparent approach to reporting fundraising costs. INPAG requires that fundraising costs are separately reported, whichever classification of expenses it uses. It also describes 3 categories of fundraising costs and how they are to be calculated. INPAG describes fundraising costs as including donations, gifts, grants, and similar transfers, commercial and trading costs, and the cost of investment management. The cost of fundraising excludes the development of documents applicable to the whole of an NPO's activities, such as the cost of business plans or annual reports, or even websites. The first category of fundraising costs is activities to obtain donations or gifts, or to win grants, from entities or individuals external to the NPO. Examples of such expenses include the costs of the following activities: seeking donations, grants, and legacies, operating membership schemes or social lotteries, staging events, contracting with agents to raise funds on behalf of the NPO, researching and developing fundraising strategies and plans for prospective donors, and advertising and marketing, provided these do not relate to the NPO as a whole. The second category of fundraising costs relates to commercial and trading activities. These will be from activities being carried out specifically to generate funds to be used in meeting an NPO's primary purpose. They could relate to operating a trading outlet to sell donated or bought-in goods, or operating a trading company undertaking other commercial or trading activities. Some NPOs make a charge or expect a contribution to partially cover the costs of services or goods they provide as part of their primary purpose. The costs associated with generating income in this way are not fundraising costs, as they are part of the NPO's operating model. The third category of fundraising costs relates to the management of investments. This applies to investments held specifically to generate financial returns. For example, an NPO may receive shares that cannot be sold, but the returns from those investments can be used for the NPO's missional objectives. Fundraising costs in the investment management category include, but are not limited to, portfolio management, obtaining investment advice, administration of the investments, costs of licensing intellectual property, rent collection and property repairs, and maintenance charges for investment property. To calculate fundraising costs, NPOs may need to allocate costs to each of these activities. INPAG requires the use of the attribution methods identified in Part 2 of Section 24 for the classification of expenses. This means that fundraising costs will be comprised of their direct costs, shared costs, and support costs. For commercial and trading activities, fundraising costs must include all costs to sell donated or commercial products. This will include those costs associated with the direct production of goods or services, shared production costs, and any support costs. For investment management costs, where investment managers deduct their fees from any investment income, the NPO should report the gross investment income before fees, and then report the management fees charged as a cost where this is possible. Sometimes activities serve multiple purposes beyond just fundraising, such as also raising awareness about the work of the NPO. INPAG requires that where there is more than one purpose, that the costs should be split. It does, however, include a pragmatic exemption. A split is not required, where the costs of calculating the split are greater than the benefits to the users of the financial statements, of reporting the costs associated with the fundraising aspect of the activity. Costs relating to each of the fundraising categories must be reported separately. All fundraising costs must be reported on a gross basis, and not be netted off income. This requirement follows the general INPAG requirement that all transactions must be reported on a gross basis. The disclosures must include a narrative description of the method of cost allocation and basis of apportionment adopted to estimate fundraising costs. Where the pragmatic exemption related to the splitting of costs has been used, it should be reported in the disclosures. Where useful, an NPO may present an analysis of revenue raised with the costs of the associated specific activities, provided that the costs are presented gross. This video has explained the INPAG proposals for the reporting of expenses in Exposure Draft 3, including fundraising costs. Expenses analysis is to be presented using a classification based on the nature of expenses, unless this would not provide the most relevant or reliable information. In these instances, NPOs may use an analysis using the function of expenses or a mixed presentation. INPAG provides guidance on the allocation and aggregation of costs through attribution to direct, shared, and support costs. This ensures that the accounts include a relevant and faithful representation of the costs of activity. The analysis of expenses may be presented either on the face of the statement of income and expenses or in the notes. There are specific disclosures related to the reporting of benefits received by volunteers, as well as losses, write-offs, and special payments. There is also additional guidance relating to personnel compensation, including consequential amendments to related party disclosures. The reporting of fundraising costs has been set out, according to 3 distinct categories: donations, gifts and grants and similar transfers, commercial and trading, and investment management. We very much look forward to hearing your feedback on the proposals in Exposure Draft 3. To respond, visit www.ifr4npo.org/haveyoursay. Download a template response document and upload your completed response or comment letter. Responses must be in English. The deadline is the 16th of September, 2024.